Are you curious to learn more about BlackRock's bullish perspective on industrial real estate? If so, we've got just the thing for you. In our captivating video, we delve deeper into the factors driving the demand for industrial properties, such as the booming e-commerce sector and the impacts of geopolitical fragmentation. Discover why industrial assets have a lower vacancy rate compared to other commercial real estate types and how their market share has doubled in recent years. Before we dive in, don't forget to subscribe to this channel for more content like this. You've probably heard the name BlackRock thrown around. As the world's largest asset management firm, when they talk, people tend to listen. Recently, they've made some waves with their perspective on the commercial real estate sector. Now, if you've been reading the headlines, you know this industry has been a bit of a roller coaster. Financial issues cropping up here and there have got some folks pacing nervously, but BlackRock, they're not hitting the panic button just yet. The firm's global chief investment strategist Wei Li and her crew are approaching this with a fine-tooth comb, acknowledging that not all sectors of the market are created equal when it comes to risk. And here's the fun part. They're pretty pumped about one particular segment: industrial properties. You might be asking, industrial real estate? Really? Yes, really. Let's break it down. Industrial properties include a wide range of spaces, like warehouses, distribution centers, and manufacturing facilities. Now think about the boom in e-commerce. All those packages showing up at your door had to come from somewhere, right? That's where warehouses and distribution centers come in, storing and shipping out the truckloads of goods we're ordering online. As e-commerce continues to grow, the need for these spaces is only expected to rise. Plus, with everyone wanting their orders delivered yesterday, this sector of the real estate market shows no signs of slowing down. But hold on, it's not all about our online shopping habits. There are other big shifts happening that are making industrial properties look mighty attractive. We're seeing a trend toward reshoring and nearshoring, basically bringing manufacturing back closer to home. This trend is driving up the demand for domestic industrial facilities. Add in the push for green energy, and you've got another reason why industrial spaces are hot. These properties can be adapted for renewable energy facilities, opening up even more opportunities in the sector. So, when BlackRock says they're going granular with their portfolio views, they're not just flipping through reports and glancing at spreadsheets. They're getting their hands dirty, digging into the nitty-gritty of each subsector in commercial real estate. Their conclusion: industrial properties are where it's at. This viewpoint from BlackRock is definitely food for thought. If you're considering dipping your toes into the real estate market, you might want to take a closer look at industrial properties. They're making a compelling case, and who knows, it might just be the opportunity you've been waiting for. Moving on, let's dive right into this sea of concerns surrounding the commercial real estate, CRE industry, that's been making some serious waves recently. The first big issue at hand is the I word: interest rates. Interest rates have this tricky way of playing a huge role in the CRE industry. When they shoot up, borrowing money becomes pricier. This can put the brakes on people looking to finance property purchases, and when fewer buyers are in the game, property prices typically take a hit. Now, pair those high interest rates with an increase in capitalization rates, and you've got investors expecting higher returns to compensate for that costly borrowing. This is another recipe for property values to dip. But interest rates aren't the only party crasher here. We've got to talk about those tighter lending standards too. Lenders have started playing hardball, pushing borrowers to meet more stringent criteria before they open their vaults. So we're looking at a double whammy for the CRE industry. High interest rates and stricter lending standards can make it both costly and tricky to get your hands on those loans. And guess what? The plot thickens. The rise of remote work has thrown a curveball into the CRE game. With the home becoming the new office for many, the demand for traditional office space has taken a nosedive. Vacancy rates are on the rise in commercial office buildings, which can lead to dwindling rental incomes and property values. Now here's the big kahuna. A chunk of debt taken when interest rates were more like kittens than lions is about to roll over. What this means is, when it's time to refinance this debt, it'll have to face the music with the current, less friendly, higher interest rates. This could crank up the cost of debt servicing and potentially tip borrowers into the land of loan defaults if they can't keep up. All these factors rolling together are enough to give investors more than a few sleepless nights. There's a real worry that defaults on CRE loans could begin to climb, and if property prices continue to drop, the value of the collateral backing these loans could take a tumble too. If this perfect storm continues to brew, we could be looking at a domino effect that might even trigger a US recession. Before we move ahead, don't forget to smash the like button on this video. Get this, the commercial real estate sector has caught the eyes of some big shots recently, none other than the Federal Reserve, America's central bank. What's more, this sector has even earned itself a spot in the Fed's Financial Stability Report. So what's this report all about? Well, it's the Fed's way of letting us in on their late-night worries about the stability of the U.S. financial system. And lately, commercial real estate has been popping up a lot in these financial ghost stories. The Fed isn't just fretting over it, though. They're upping their vigilance on commercial real estate loans. This isn't surprising when you think about the potential domino effect that troubles in the commercial real estate world could trigger in the broader economy. If property prices begin to drop and loan defaults rise, the banks holding these loans might find themselves on thin ice. Worst case scenario, we could be looking at a banking crisis, so it's clear why the Fed is doing its best to stay one step ahead and keep a close watch on potential risks. But here's where the plot thickens. Not everyone's sharing the Fed's concerns about the commercial real estate sector. Enter stage right, BlackRock. BlackRock has stated that commercial real estate is not a monolith, and you know what? They've hit the nail on the head. Commercial real estate is a vast playground, home to office buildings, retail spaces, warehouses, industrial facilities, the list goes on. Each of these subsectors dances to its own tune and has its own risk-return dynamics. BlackRock insists that despite the general doom and gloom, there are pockets of value to be discovered within the sector. This suggests that there are specific areas in commercial real estate that, despite the stormy weather, offer a safe harbor with a chance for potential gains. One such promising spot is industrial properties. With the e-commerce boom and the reshoring of manufacturing, warehouses and factories, that is, industrial real estate, are expected to see a surge in demand. BlackRock, our financial expert buddies, remind us that this real estate is really a bunch of different types of properties, each playing its own tune. Take industrial real estate. It's catching BlackRock's eye thanks to two movers and shakers, e-commerce and geopolitical fragmentation. E-commerce is no stranger to us. It's been on a tear, and COVID-19 put the pedal to the metal. With more folks shopping online, demand for warehouses and distribution centers has surged. Then there's geopolitical fragmentation, basically countries or regions doing their own thing more often due to political or economic rifts. This can lead companies to bring their manufacturing closer to home, fueling demand for domestic manufacturing facilities. Another member of the Industrial Real Estate Club. Considering these drivers, it's no wonder BlackRock is all in on industrial real estate. The stats are singing the same song. Industrial properties had a vacancy rate of just about 2% in March. That's a lot lower than most other types of commercial real estate, pointing to some serious demand. Plus, industrial real estate's share in the overall commercial market has doubled since 2016, according to the National Council of Real Estate Investment Fiduciaries, NCRF. What we're seeing here is BlackRock's granular approach. It's about diving deeper, not getting swayed by the broad narrative, but sussing out the details in each subsector for valuable investment opportunities. You know, even with all the uncertainties hanging over commercial real estate, BlackRock sees the glass as half full, especially when it comes to the industrial sector. The big takeaway? Don't lump everything together. Get into the nitty-gritty, grasp what's unique in each corner, and follow the big trends like e-commerce. That's how you might just find some golden opportunities, even when the market gets a bit rocky. So what's your take on all of this? Let us know in the comments. Stay tuned for more.